Hello, everybody. Hope you're doing okay. This is our second week. Another we're in the middle of it, and towards the end of that homework process, I wanted to give you a brief summary of a couple of very important parts of the chapter. The first one would be related to the definitions, so the different definitions of costs. And then the second one will be about cost flows, including um, the T accounts and the journal entries that apply in each part of the process. So I'm going to be using two or three screens here with that info on them. So let's start with this one here. As you can see, at the moment I'm showing you a table with different sort of terms, and they all relate to costs, to costing of at some level. So if you look at the first one, capitalized versus expensing, I just wanted to remind you that capitalized simply means that you're going to be booking the cost of inventory into an asset account on the balance sheet, not into the income statement as expense, which would be the other way to do this. So remember that there's different ways to account for costs. You either do it currently, and that means in the income statement as expense, or you capitalize it into the balance sheet as an asset. So that's the difference between capitalizing and expensing. Then we go to product costs versus period costs, and here you've seen this before, but in a different context. And here, product costs means any costs that relate to the manufacturing of a product. So materials, labor, and overhead would be the three categories that are under product cost. Also, you can also refer to these as manufacturing costs, so it will be the same thing. What you've seen in a different class with respect to operating expenses, that's what now we refer to as period costs. So you can think of these as actually selling and administrative expenses. So all the current expenses in the income statement. Obviously, the product cost would go into the balance sheet as you produce the product. Next category is direct versus indirect. So direct manufacturing costs versus indirect are obviously both are product costs, but there's a difference. Direct manufacturing cost relates to any cost that you can trace into the making of each unit. And so that means direct material and direct labor normally. Anything else would be indirect. Anything such as machine lubricants, anything indirect labor, supervisors, janitor working at the manufacturing plant, accountants also in the manufacturing plant, anything that has to do with manufacturing but is not directly traced to units of production, then it would be indirect. And the difference here will be obviously also noted later when we talk about overhead costs. I guess that will be the next one. Next is conversion. Conversion costs is anything that you used to convert direct materials into finished product. So obviously you submit or you introduce materials into the manufacturing plant, and then you use labor and manufacturing overhead or factory overhead. Either way is the same thing. FOH, MOH, same thing, or OH, same thing. So direct labor and all the indirect stuff that goes into making the product, those are conversion costs. Direct materials and direct labor on its own, category would be called prime costs. Now, with respect to overhead, that category would include, as I said before, anything that is actually not direct materials and not direct labor. So it includes indirect materials and indirect labor plus everything else. So keep that in mind. Next would be the difference between variable and fixed costs. Variable costs vary with in direct proportion with the changes in the production of units. So when you go from unit 1 to unit 2, or from unit 150 to 151, the variable cost will move proportionately. And if that happens, then it will be actually variable. Fixed costs, on the other hand, don't change from one unit to the other. They may change at certain points, but it's more of a step process, a long step. So going from 1 to 2, the same fixed costs would apply. If it actually changes, then it wouldn't be fixed costs. Now, there's actually another category that will come later in a different chapter. It's called mixed costs, and in that case, it will be kind of a mixture of both of these in one. But we'll talk about that later. But for now, understand the difference between variable and fixed costs. And then there will be other things that you may also look into. Differential costs are those that are actually costs that apply to two different scenarios or two different options. So if one item differs between option A and option B, then you call that differential cost. Sunk costs are anything that any cost that doesn't really change no matter what you do. You might have two options in front of you, but a certain cost or a certain portion of a cost will not change no matter which one you do. You would call that a sunk cost. There's also something called opportunity cost, which you probably have seen this in your economics classes if you actually have taken that already. And finally, there will be other things in terms of quality. Quality costs are all listed there: prevention, appraisal, internal, and external. And I don't think that's actually listed in your chapter, but that's okay. I just wanted to give you sort of a broad overview of the different terms for costing. Now let's talk about cost flows. Now, in the book, they will give you something like this, where they show you that costs flow from the basically from the balance sheet here on this left side all the way to the income statement through three inventory accounts. So as we said before, there's raw materials, there's direct labor, and MOH, and that goes into the balance sheet this way. So the costs of materials are first the cost that you actually incur when you purchase materials. That will go into your materials inventory account, and as you actually use them up, those are introduced then into the working process or the manufacturing plant. That's how I think of the WIP account. Working process, I would think of it as WIP, as manufacturing process here. And so direct labor and MOH are also introduced at that point. So all costs, direct materials, direct labor, and MOH are all brought together in the WIP or in the manufacturing plant. Eventually, when the units are actually finished, they are moved over to the finished goods inventory, which eventually, when they are sold, they are actually then moved over to the cost of goods sold line of the income statement. At that point, you add all the other period costs, and you actually get to the net income amount. Now, I'm going to show you the very same thing now using my own graphic. And so it's kind of the same thing as I showed you before, but I wanted to give you sort of a more of a overlaying different layers of information on a single view. And so again, here you have a purchase order. You purchase materials, so you go on the debit side of the raw materials T account or general ledger account, and as you use them up, you can actually credit the raw materials account. Indirect goes into the MOH account, and the direct materials goes into the WIP account. Direct labor is directly placed into the WIP because you cannot inventory labor, so it will be directly into the manufacturing plant. And by the way, look at this. Warehouse, raw materials, manufacturing plant, WIP account, finished goods warehouse, finished goods inventory here. So again, in terms of WIP, you have the raw materials coming from the warehouse here for materials. The debit, the credit here becomes a debit here. Obviously, that's how you figure out the journal entry itself. The raw materials, and then MOH. Notice here is sort of an interesting and complicated concept at times for some people. MOH, or overhead, has debits coming from indirect materials that are used as you produce. These are actual on this side, on the left side, indirect labor, and also anything that is in all the other overhead accounts. Actual costs go into the debit side, but that's not what gets transferred over to the WIP account. It's actually the credit is determined differently. It's an estimation based on some kind of predetermined cost driver, and that takes a little bit more explain to do, and probably you can look at the book, or I can probably maybe later produce another video just focusing on MOH applied. So there's a difference between actual debit side and applied, and it could end up with having a balance at the end, because you don't know the actual until the end of the year actually. So that's the reason you have to do applied. So you basically assume something and you apply it into WIP. And again, once you accumulate all these costs in here on the debit side of the WIP account, these are your current manufacturing costs, which is not the same thing as cost of goods manufactured, meaning finished. Once you finish, then there's certain parts of this account or certain portion of this account that gets processed, finished, and moved over to the finished goods inventory on the debit side. So you credit WIP and you debit finished goods inventory. And when you sell them, you credit finished goods and you debit then you credit inventory and you credit cost of goods sold. So then I'm going to actually show you now another version of the same graphic that you see here, but now overlaying on top of that, I will overlay the actual journal entries. So this is what you see here. So again, if you look at the purchases, you see debit raw materials, credit cash. As you requisition materials, direct materials move over to WIP with a debit to WIP and a credit to raw materials. Then the indirect portion goes to MOH. Labor is just simply is it there? I don't remember where. I don't see it there. Might be this one here. Yeah, this one. MOH is actually what you debit for labor, direct labor, and you pay cash or for wages, obviously, and that will go there. And then you then do here's labor. I'm sorry. So here's labor. You debit WIP for the labor total. I'm sorry, for the direct labor, and you actually gonna then credit wages payable, and the debit goes to MOH for the indirect portion of labor here. That makes more sense. And eventually, when you finish the product, you're gonna again debit the FGI account and you credit the WIP account here. And then when you sell it, you're gonna debit the cost of goods sold and credit FGI. And again, this is how you end up with operating income. And one last little note. Notice that on top here I have some sample documentation that serve as our source documentation for doing the actual accounting for these things. I hope this proves useful. Enjoy.